For decades, it was the biggest game in town. A tech giant like Apple or Google could make $10 billion in sales in a high-tax country like Germany and pay almost zero tax. How? By legally shifting those profits to a subsidiary in a tax haven like Ireland, Bermuda, or the Netherlands, which charge them a corporate tax rate of 12%, 5%, or even 0%. This was the race to the bottom. Countries were forced to slash their own taxes to compete, starving public services of trillions of dollars. Then, in 2021, over 130 countries, led by the OECD and U.S. Treasury Secretary Janet Yellen, announced the end of the game. They agreed to a 15% global minimum tax, GMT. It was sold to the world as a historic victory for fairness. But now that the dust has settled, we must ask, who really won?
To understand the winner, you have to understand that this isn't just one rule. It's a complex two-part system. Pillar 1 is the digital tax solution. It targets only the largest multinationals, like the top 10 tech giants. It says they must reallocate a portion of their profits and pay tax in the countries where their customers actually are, not just where their headquarters is. This was the compromise to stop countries like France from hitting U.S. tech firms with their own digital taxes. But Pillar 2 is the famous part. This is the 15% minimum rate, and it applies to all large companies with over 750 million euros in revenue. And it works through a genius and ruthless concept, the top-up tax. Here's the example. A major U.S. corporation, let's call it Megacorp, has a subsidiary in the Cayman Islands that makes $1 billion in profit and pays 0% local tax. Before, that money was untouchable. After the GMT, the U.S. government, the home country of Megacorp, can look at that 0% rate and say, you owe the 15% minimum. The U.S. can then charge Megacorp the full 15% difference. Crucially, that $150 million in tax is not paid to the Cayman Islands. It is paid directly to the U.S. Treasury. This mechanism instantly makes every tax haven on Earth obsolete.
This is a complex global shift with massive consequences. If you appreciate this kind of analysis that decodes the fine print of world economics, hit that subscribe button and join our community. So, who are the winners and losers in this new game? The obvious losers are the classic tax havens: Ireland, the Netherlands, Bermuda, and the British Virgin Islands. Their entire economic model of offering low tax rates to attract company headquarters is now broken. There is no longer any benefit to a US or German company parking its money there. The real winners are the rich, high-tax home countries: the United States, Germany, France, Japan, and the UK. For decades, they watched their multinational corporations legally hide profits overseas. With this one single rule, they effectively built a tax cartel. They gave themselves the power to reach across borders and reclaim all the tax revenue they had been losing. It is a massive financial victory for the world's richest nations. But this deal has a third, hidden player. The surprising losers are the world's developing nations. Think about a country like Vietnam, Malaysia, or many nations in Africa. They cannot compete with the US on infrastructure, skilled labor, or stable capital markets. For 50 years, their single greatest tool for attracting foreign investment was the special economic zone. They would tell a company like Samsung or Intel, if you build a $10 billion factory here, creating 20,000 jobs, we will give you a tax rate of 5% for the first 10 years. This was a smart trade-off. Sacrifice tax revenue in exchange for jobs, technology transfer, and real infrastructure. But under the 15% global minimum tax, that tool is gone. Why? Because if Vietnam offers Samsung a 5% rate, Samsung's home country, South Korea, will simply top up the remaining 10% and collect the tax for itself. Vietnam loses the tax revenue, and Samsung loses the incentive to invest. The developing nation has lost its main bargaining chip, while the rich home country gets the tax money anyway without any of the investment.
The 15% global minimum tax was marketed as the end of the race to the bottom. But in reality, it solved one problem only to create another. It ended the power of tax havens, but in doing so, it established a rich country tax cartel led by the OECD and G7. It's a system where the nations who wrote the rules ensured that they would be the primary ones to collect the cash. It leveled the playing field for them, but it may have just pulled up the ladder on the developing world. So, what is your take? Is the 15% global minimum tax a landmark victory for fairness? Or did the world's richest countries just pull up the ladder on developing nations?